we're up 375 basis points on the year. And right now we're at a point where we're going to enter a restrictive stance of policy. And at that point, I think it makes sense that we can slow down a bit the rate of pace or the pace of increases. We're still going to have to raise the funds rate. But we're at a reasonable point now where we can then sort of now be very deliberate in setting monetary policy.
And that was Cleveland Fed President Loretta Mester on CNBC yesterday. Join us right now to discuss all of this recent Fed speak and how markets are reacting. Sylvia Jablonski is here, Defiance ETF CEO, and also Megan Horniman, Verdance Capital Advisor CIO. Good morning to both of you. Sylvia, we've heard a lot of Fed speak. And by the way, the Fed speak has been coming from all different sides. So you hear Jim Bullard say things actually may not be so great. Then you hear, Loretta Mester yesterday. You obviously have Jay Powell out there who's been talking about just the credibility of the Fed and maybe the idea you got to keep going. I can't figure out if they're trying to soften the market up or they're trying to harden the market up here.
Good morning, Andrew. Yeah, and look, I think they're definitely having an impact on the market either way, right? So every time we get them out, in the press and media vowing to keep rates higher for longer and being restrictive, we see the market pull back on that a little bit. So it's almost as if we have this, CPI falling, PPI falling, that past Friday, great news, the market rallies, and then they sort of come in and say, whoa, let's rein this in. We're not going anywhere. I think the importance of this, though, is really going to impact the medium-term outlook for the markets. Until we see inflation contracting, until we see the economy slowing, and then the reaction that the Fed has to that in the medium term, I think we'll sit in the same type of market that we're in, sort of sideways, range-bound volatility without direction.
Megan, what's your take here? And are you of the view? I mean, I feel like we're getting told a different thing almost every day. I don't know how organized it is. I mean, we always talk about that. How much of what the Fed and these different Fed players are saying is coordinated in advance?
I don't know how much of it is coordinated in advance, but you brought up a good point. There's a lot of different information coming out, very different views on a regular basis. And then throw in the economic data that we've been getting. The data continues to kind of mix the market's emotions as well, because you have a softer CPI print, and then a couple of days later, you'll have a strong retail sales report. So I think that right now the market's just trying to figure out how far, what's that terminal rate that everybody's focusing on. The one thing I'll tell you is all this Fed speak, no one's talking about cutting rates. So even if you look at the Fed funds futures contracts that's looking for rate cuts in the second half of next year, I think that's a bit aggressive. What we do know is regardless of whether or not they're going 50 or they're going to go 75, they're going to continue to hike rates. They're going to then probably pause, assess the situation. And then don't forget, we still have the balance sheet unwind that's going to start to pick up as well. So we are in a restrictive monetary policy cycle. So some of those areas of the market that have been beat up this year, I still think there might be some room for those areas to weaken as well, especially as we go into next year.
Okay, so you, Megan, you still sound relatively, I'd say, bearish to flattish. By the way, Goldman Sachs is bearish to flattish too. Sylvia, are you bearish to flattish in terms of what you think the end of 23 looks like a year from now?
Yeah, I think I'm bearish to flattish through the end of, or at least halfway through 2023. Again, I think some things could change. So, if you look at sort of the Goldman Sachs review, there are a lot of things that I think that, they're sort of indicating could happen. And that could be a typical recession where we'd see the S&P 500 fall back to that average 37% level that, happens in a recession, that we see earnings fall. But I do think that there are some different things going on now, famous last words, this time it's different, but as Megan said, the consumer remains strong with savings. That's indicated by the retail numbers. The jobs numbers are strong. So while I do think we could see earnings fall a little bit more, perhaps it's the last shoe to drop, the Fed is directionally, I think, slowing down. We're not going to be to the end of it. But I think, if we get news in the first quarter of 2023 that Fed is going to start rate hikes and CPI, PPI keep coming down, manufacturing remains in contraction territory, perhaps it's halfway through the year and not all the way to the end. But, we won't have a face ripper in coming months.
Sylvia, make this practical for us. What is the Jablonski family doing with its money right now?
Yeah, the Jablonski family is long-term invested. We're looking at Microsoft, we're looking at Amazon, we're looking at Google and NVIDIA, everything that is essentially the staples and the future of the next industrial revolution. So everything from 5G, artificial intelligence, globalization, replacing all these workers that we can't find to keep factories running, the growth in cloud. None of these things are going away. They're slowing down, they're cutting costs. And a few years out, Amazon and Google and Microsoft will have looked like great trades.
Megan, what do you do with, if you have any dough, what do you do with it?
Yeah, so same philosophy for us here. We're longer-term investors. So while I do think that the next couple quarters will be a challenging one from the economic standpoint and even the earnings standpoint, we're looking beyond that. Second half of next year, 2024 specifically, it's going to be a very different economic environment and a very different monetary policy environment. So we're looking at areas of the market that have priced in all of that bad news that we expect over the next 6 to 9 months. We're looking at small and mid-cap stocks. I know a lot of people wouldn't look at that, especially when you're looking for a recession to start possibly in 2023. But these areas of the market have fallen so much that valuations look attractive. And I do think with a long-term time horizon offer a lot of value. Don't forget international stocks as well. Looking at things like the euro or the pound, I mean, these currencies are pricing in basically a near collapse of these economies, and that's just not the case. These economies will turn around, and when you look into the longer term time frame, they're very cheap and very attractive in our opinion. So we don't have a problem with going where the money's not going and being a little bit early to the trade, but focusing on that long term.
We'll probably have to do Bitcoin with you guys another time. Sylvia and Megan, thank you both. Appreciate it. Melissa?
Thank you.
By the way,